Good morning again, everyone. Welcome to Q2 earnings call for December 31st, 2023. I am Ryan Landy, Assistant Vice President in the Investment Management Unit, and will be guided by Jason Morris, the Chief Investment Officer of SYGNUS Capital, through this presentation. Please be reminded that subsequent to this call, the recording will be available on SYGNUS's website, and the information presented here should be read in conjunction with the information published on the JSE. Jason, over to you.
Hi, good morning, everyone. I hope you all had a fantabulous Valentine's Day. And some of you may still be celebrating. I'm not sure, right? But yeah. So let's jump into the Q2 6-month earnings call for SCI. I want to start off by just giving some background to the performance over the 6 months. Ryan, I'm not seeing the slide, the first slide. Okay, until that technical difficulty seems to get worked out. So turning to the first slide, some major half-year highlights for SCI. There were some major milestones that were achieved. The first one is that SCI would have, reported a record performance for Q2, the second quarter, although the 6-month period would still, been affected by what happened during Q1, September 2023. So looking specifically at Q2, we would have had record net profits, driven by record core revenues, record net investment income, and of course, record fee income. And we would have communicated with shareholders on a previous earnings call that we are strategically focusing on increasing complementary income to net interest income in order to get earnings per share up. And we have indicated at the time that our generalized target is for us to get to beyond 20% in terms of fee income being at least 20% of total investment income. So that's something that we would have communicated, I believe, maybe 2 or 3 quarters ago. 2 quarters ago, well, 3 quarters ago, we would have said that we wanted to start this. And so we start to see the first fruits of that being born, and I go through that later in the report. As for St Financial Corporation in Puerto Rico, the Puerto Rico business, that business would have generated record net profits both for the 6-month period and for the quarter. They would have also had record originations for the 6-month period and record deployment for the 6-month period. So that business is really going good. Yeah, if you recall, the entire reorganization and the full integration of the business would have occurred effectively July 1 of 2023, right? Or the end of the last day of the financial year of SCI, June 2023 / July 1, 2023, right? So the company now has the same reporting time frame and everything in stream. So this is basically the first 6 months of that company operating on the same schedule as SCI, with a pure private credit balance sheet, meaning there are no employees in it. It's just a pure private credit finance and operation. And in keeping with that, SCI would have also increased its stake in the company to 95.6%, adding an additional $3 million of investment in the company. And I'll go through that later. Third milestone I want to speak about, which everybody already, well, most persons if you are from Jamaica, would know about, is the capital raise, which we did in December. And that, of course, the actual completed figures would be a record $50.4 million US dollars equivalent, which would be the largest capital raise in the history of SCI. And in fact, I think it was also the largest capital raise, a public capital raise, and a JC for all of 2023. So we thank shareholders and investors for that. And fourth item is dividends during the quarter and the 6-month period. SCI would have, of course, paid to shareholders a record 1.6 million in dividends, in keeping with our strategy to, in steady state, get that dividend yield up as the company is growing from strength to strength. And finally, but certainly by no means least, the overall private credit platform / private credit portfolio that SCI effectively has control of. So, assets under management would have crossed the $250 million barrier at the end of December, with most of that being SCI proper, but the Puerto Rico business also, coming to a new record during the period. So combined, when you take SCI's portfolio and you take the AUM that's in Puerto Rico under SCI specifically, the AUM combined has exceeded 250 million for the first time in the SCI's history. So that's another milestone for the company to celebrate. And of course, over the 6-month period, combined, Puerto Rico business, SCI, English speaking Caribbean business would have had a total of 50 million in deployment over the period, which is a very, very good deployment over that period. But as we speak, based on the undrawn commitments that existed at the end of the period, that number, that achievement could be superseded in upcoming period if all of the undrawn commitments are actually funded between January 1st, 2023 and and say the end of March, heading into the last quarter. And I'll give some more insight in that later. All right, so into the performance for the quarter, and specifically, I spoke about the fact that the quarter itself would have generated new records at almost every level. So net profits 1.53 million, up a decent 24.6%. Total investment income at 2.5 million, up 10.5%. Net investment income 1.5 million, up 18.5%. A lot of these are new records. And EPS was 0.26 US cents versus 0.21. And of course, I spoke about the dividend, 1.6 million versus 1.55. Now, I said before, net interest income performed really well for the quarter, up 21.3% to a new record. And of course, fee income, participation and commitment fee income, increased to a new record. And currently that's 8.4% of total investment income. We have just started this process, as I would have spoken about, I think, 2 quarters ago. And our medium-term strategy, as I said before, is to get this above 20%. So, we are pushing very hard as we move quarter by quarter to see improvement in fee income, both in nominal terms, but most importantly, as a percentage of total investment income. Of course, in terms of dividends, the SCI's board will be convening a meeting of the directors tomorrow to consider an interim dividend if they see fit, as per usual. Moving on to the 6 months performance highlights, net profit. So the entire performance of the 6 months looks, different from what the quarter was. And of course, this is being driven by the Q1 results, and I'll explain this in a little bit. So during Q1, we would have had an unrealized loss of 539.7 thousand on the Puerto Rico Credit Fund, based on the value that was derived from SCI investment in the PRCF, which is not consolidated all the way up to SCI, because the investment does not meet all three criteria based on the accounting standards to be consolidated. So we have to do a kind of fair valuation of it. Now, during the September period, interest rates were pretty high, and therefore the methodology used to do the valuation meant that the price or the value of the investment went down relative to where it started at the start of the financial year. As I would have opined on at AGM, and I'm opining here again, rates would have been a bit more favorable in the December period. So for the quarter, would have registered a gain, but the gain that was registered was 102.3 thousand. So when you take the 539 from Q1, which is an unrealized loss, and the 102.3 for Q2, you add them together, you get 437.3 as an unrealized loss. So we have not made up completely for the unrealized loss, right? But we are not worried about the gyration that we are seeing. As I said before, the full integration of PR into SCI is just 6 months old now, and therefore the trajectory of profitability that the company is generating, over time, we expect that the movement in market multiples won't be enough to offset the increase in the book value that we're getting from the rise in net profit. But because we have just started, the movement in the market multiples is a little bit outside, because in fact the company actually had a record performance for both the quarter and the 6 month period, and it also had a record deployment. So I need to state that very categorically. It's not that the company is making losses, right? Yeah, so we are happy about the performance of Puerto Rico and the Puerto Rico team, which celebrated the 20th anniversary during Q3, during the fourth quarter. So we need to give them some kudos. So net profits for the 6 month period, because of what I just explained, would have been impacted with it being at 2.28 million, down 20.3%. Total investment income, was 4.15 million, down 8.6%. And I just need to highlight that net investment income for the 6 month period was actually a new record. It was actually up 28.2%. So that's a stunning performance for net investment income. If you look, and I'll show you on the next slide what I mean by Puerto Rico, the movement in market multiples substantially affecting the Puerto Rico credit fund investment income. Because if you take an unrealized loss of 437.3 and you look at what the figure was last year, which was a gain of over $1 million, because the number is negative, right? You're literally doubling up the gap, because you have $1 million positive and then you have 437,000 negative. That's like 1.5 million a gap to make up, and net investment interest income simply could make up all of that gap in one quarter. But as I said before, we're not worried about Puerto Rico. As we go through various quarters, the performance of the firm will overcome the challenge that we're currently seeing. So net investment income, 2.06 million, down 22.5% because of the aforementioned reasons. Earnings per share, 0.39 US cents versus 0.48 last year. And the actual dividend per share that was paid in October was 0.00272 US cents versus 0.00262 US cents. And of course, that was based on the record dividend dollar value paid. Now, to walk you through very briefly what I meant, on this slide where I'm showing the summary result of operations, you can see where net interest income, the steady record of net interest income of 2.18 million versus 1.799 million for the quarter, and also for the 6 month period, you're seeing where net interest income, as highlighted on the chart, achieve a new record, right? So there's no problem with the growth of the company in terms of its fundamental, hardcore cash earning potential. And bear in mind as well that interest expense that is being shown here includes the financing for the acquisition of Accrescent, with no attendant interest income flowing in from Accrescent, because Accrescent is not consolidated in the financial statement. And that's the reason why where you see the Puerto Rico Credit Fund investment income showing that unrealized loss for the 6 months, why I'm saying that pretty much the 6-month results would have knocked over a new record were it not for what happened during Q1, which as I explained on the previous slide. So you can see the gap for the 6-month period where last year 1.14 million versus unrealized loss of 437K. That gap is effectively 1.5 million, right? And the gap in net interest income would have been $1 million bigger than last year, but as you can see, we can't make up that gap in one single quarter. But as I said before, we're not worried. And of course, you look at participation and commitment fees, you see that last year, 33,000 versus 272 for the 6 months, similar for the quarter, very strong up performance. And if I venture to say that we expect that a continuation of this trend in Q3. And if you look at the financial year, for all of last year, we made 379K in those fees. And based on the trajectory that we are on, we would expect to be on a good path to beat that. So, I mean, that's what I just wanted to highlight, because I know that people may have questions about Puerto Rico Credit Fund investment income or be confused. I think there was actually a report somewhere saying that we are not fully accounted for the acquisition in Puerto Rico. That is actually a blatantly false statement. As you can see, every single financial reporting period since we did the acquisition, we have put the asset on the balance sheet. Our auditors have audited the company twice, audited SCI's financial report twice, and in all the audited financial statements, it is there. And the impact of it flowing through on the income statement has been there every single quarter since the acquisition. So that was very poor reporting, and whoever did that reporting. Just wanted to highlight that specifically in case anyone on this call is confused about that. I have questions on it, which I can take in the Q&A as well. Moving on to the next slide, in terms of efficiency and management expense ratios, we typically report this on a year-to-date basis. So you can see that for the 6-month period ending Q2 2023, the efficiency ratio is out of whack, so to speak. We are at 50.4%, and our target threshold is 40%. Of course, all of this would have been driven by what happened during Q1, because our core income or total investment income would have been severely impacted by the unrealized, by what happened with the PRCF, right? Of course, if we measure just the second quarter alone by itself, we are bang within the 40% threshold. So for the quarter, Q2 quarter, which is October 1 to December 31st, the efficiency ratio was actually 39.3%. But obviously, despite the fact that we have that unrealized loss position on the Puerto Rico Credit Fund, right? But obviously, in Q1, we would have been way out of the threshold because of what happened during Q1. So we are plugging away at making up the gap over the next 2 quarters. As for our management expense ratio, which is also perhaps even more important, which is taking how much dollar of expenses are, how much dollar of assets under management are being driven through expenses, which means this is money that can be utilized to either reinvest in new investments or to pay out as dividends or to buy back shares, right? You can see that this year is well within the threshold of 2.85% at 2% versus 2.4% last year. And so, we continue to manage the company according to international best practice, as far as expenses go to ensure that we run a tight ship. Quickly on the balance sheet, shareholders' equity up to 70.5 million. I think this should be a new record for shareholders' equity, up 2.5% versus 68.8 million last year. And for total assets, the balance sheet is now at a record 206.6 million, up 34.5% versus last year. Of course, the balance sheet would have grown substantially during the quarter because of the record capital raise that would have been completed right at the end of the quarter in December. On the next slide, in terms of what we're looking at on the balance sheet and the metrics that we use to ensure that we are monitoring the performance of the company. So making profits is one thing, but you also have to pay attention to the structure and nature of your financing and your leverage levels, etc. So debt to total assets fell to 0.18%, and all of these ratios, of course, would have been impacted by the capital raise in December. Asset coverage ratio was now 2.55 times, well over the 1.5 times threshold target, and the adjusted net debt to equity ratio, which adjusts for the preference shares that were raised, is now at 0.29 times versus the actual limit of 2 times, and our sweet spot, which is to be at just about 1.25 times. Of course, generally speaking, that SCI has a target margin of making 500 basis point spread, and this is an all-in spread in terms of when you look at the fees that we can generate, which is normally paid up front, as well as the difference between our borrowing cost and the cost that we invest at. We typically want to have about 500 basis points spread between the two. And as we scale the business, obviously the intention is to widen that margin. As I would have mentioned on many occasions, with a much larger platform, we can syndicate large transactions. And when you syndicate transactions, you make upfront fees, and those upfront fees goes directly to the bottom line instantly. You don't have to wait 6 months or a year to earn net interest income on that, right? So that's very important. Now, looking at the portfolio activity for the second quarter, investment in portfolio companies would have increased to a record 156.3 million, up from 136.1 million last year. Of course, this includes 27.4 million in the Puerto Rico Credit Fund. We would have deployed an additional 3 million in the Puerto Rico Credit Fund, as I would have shown on the previous, spoken about earlier. Puerto Rico Credit Fund actually delivered record quarterly and 6-month profit. Of course, I know that people are going to ask me what those numbers are, but I'm not really going to reveal those per se. And would have originated more than 40 million US and deployed just maybe more than 80% of that, right? Think about Puerto Rico being in a 100 million US dollar economy. So it's naturally going to have a much faster run rate than SCI, all of SCI's English-speaking Caribbean territories combined. So I'll speak about that a little bit more on a couple of slides down. But we are happy to deploy additional capital into Puerto Rico to help grow that business, following the full integration of that into SCI. Portfolio company investments, 35 versus 34 same period last year. You may say, well, why aren't the number of portfolio companies growing? You have to remember that we also would have exited investments during the period. So it's a constant churn that's happening in the portfolio where companies are coming on, but you're also exiting investments, right? But we're not worried about growth. Of course, during the last quarter of last year, growth in terms of deployment, it would have slowed a little bit, obviously, because we pretty much didn't have a lot of capital to deploy, right? Of course, have a substantial amount of dry powder, relatively speaking, to deploy into new investment. So new investment commitments would have been 4.4 million versus 7.4 million, which was lower than last year for the reason I identified before. So I expect that you could say that for the upcoming Q3 period, that the new investment commitment is going to be is likely to be higher than what it was for the same period last year, given the amount of unfunded commitment I spoke about on the very first slide. Across the platform, we have had more than 50 million in unfunded commitments, and unfunded commitments simply mean that these are commitments already, right? Approvals have been granted, I's have been dotted and T's have been crossed, and documents have been signed, and approvals have been obtained. So it's just the cash to fund the transaction. So you can read into that what you may. Pay value yield, 14.6% versus 14.1 last year. A tenor, averaging roughly 1.7 years versus 1.6. So you're looking at SCI, average investment tenor 1.7 years, and we're generating double-digit yields. Again, every quarter when I come and report this, I'm amazed at the reason why the stock price is not more buoyant, but we'll get into that at another time. Dry powder on balance sheet, 43.5 million versus 10.8 last year. Of course, this does not include 5.4 million in undrawn credit facilities, because when we received the proceeds from the capital raise, of course, the first order of business would be to pay down revolving credit facilities. You don't want to have credit facilities drawn and paying interest on those credit facilities while you have the cash, which you can't deploy it, all of it at once, right? So the first order of business would obviously pay down some credit lines up front, and then have those to redraw so that you reduce the amount of capital that you're paying interest on. Of course, notwithstanding the record capital raise, we continue in earnest our discussions where we are seeking 100 million in credit facilities from international financial partners, and we continue to work assiduously. Due diligence process continues. We are advanced with one of the partners we are quite advanced with one of the partners. We expect some what I would call advanced news, hopefully before the end of this quarter. Of course, once we receive any information that shows that we have moved the needle, we will communicate appropriately and instantly and immediately to shareholders, as we normally do. But just want to put it out there that the capital raise of 50 million does not mean that we sit back on our laurels and become comfortable. We are pushing very aggressively to get in as much as we can from that 100 million target, so that the dry powder that we have and the capabilities that we want to do to scale this platform substantially to dominate the Caribbean region in this specific niche of alternative investments called private credit, that we can do it. So on to the next slide, in terms of just giving you some generic information about Accrescent, right? Of course, Accrescent, as everyone knows, one of the largest private credit platforms in Puerto Rico. So for the 6-month period, it would have had record originations that exceeded 40 million and would have deployed about 75-80% of that, which is also a new record. That's very, very good on a forward-looking basis. The average portfolio average about 79.2 million during the quarter. Of course, Accrescent business model is a bit more advanced than SCI, where they typically sell off a part of their balance sheet and then book that income and then reuse the capital. So it's important to look at the average size of the portfolio. And of course, this now is the clean portfolio relative to what it would have been before. We would have had on the balance sheet, flowing through the balance sheet, assets that are not full earning assets, right? Are not what you call net earning assets. This is a clean private credit balance sheet that we're looking at, and the intention, obviously, is to get this to 100 million US dollars as fast as possible. And of course, in keeping with that mandate, that's one of the reasons why I would have injected an additional 3 million US, because that 3 million US can actually attract additional financing from Puerto Rico that will help the balance sheet grow to $100 million threshold, which of course will flow back into to the benefit of SCI shareholders. New investment commitments during the quarter, over 25 million, which is a substantial for one quarter. I think that's close to a record for one quarter as well. So you can see, if you look at SCI's deployment during the quarter and look at Puerto Rico for the quarter, you're talking about, although we had a sedated quarter because we were running out of dry powder, but even in some of our best quarters, normally when we do 25 million, it's a one-off thing. See what I mean? But this is natural and normal for Puerto Rico because $100 billion economy. So clearly, if you think about the long term or the medium term really, at some point the Puerto Rico business is going to be bigger than the SCI business overall, and we'll be generating the majority of the revenue and therefore profitability. But of course, we are ways from that. I'm just saying, looking down the road, that is what one would expect as long as we execute our strategy properly. The yield in Puerto Rico just over 11%, and the tenor averaging about 1.3 years. So you see that it's bang on target with what SCI is doing, and this is one of the reasons why it made sense for us to do the acquisition. Now, speaking about performance and growing portfolios, etc., and deployment, all of that is for naught if we can't manage the risk proactively. So when we look at our non-performing investment ratio, that was 1.1% versus 1.5% last year. We still have the same two non-performing assets on the balance sheet. Of course, we would have written off previous financial year, had our single write-off, which is a bankrupt entity in Cayman Islands. Of course, we are pursuing all avenues to try and recoup some, if any, from that asset. But as I would have stated on many occasions, I'm not holding out. I'm not very optimistic, but we are still pursuing all channels available. As for the other two assets, one of them, which obviously is public information, a $1 million exposure to a Jamaican hospitality firm that went bankrupt. That firm, of course, would have started operating again, would have been sold, and we are pursuing the usual channels to recoup our monies through two channels: one from the proceeds of the sale of the asset, or from the collateral that we actually have. So either one or the other, or a combination of both. And whenever we have information to update you on with regards to where those proceedings are, I will provide that. At the moment, I don't have any update other than that we are perhaps nearer to the end of determining the proceeds of the sale, and how much of that will flow back to us, if any, as well as whether or not the collateral that we have, do we need to pursue recouping our monies from that. So, once we get to that stage, I'll provide an update on that. But needless to say, those are proceeding, and we are very optimistic about recouping our money one way or the other from this asset. The third asset, which is in the mining and quarrying industry, that company is Stage 3 asset, and we are obviously pursuing our channels there to recoup our capital from that mining and quarrying company, which is a Jamaican firm. So, there are no new charge-offs during the quarter, the 6-month period, but just providing an update on these two outstanding um, defaulted credits. In terms of the balance sheet expected credit loss charge, we are committed to show this on a continuing basis. The ECL, so this is the expected credit loss as a percentage of the total private credit portfolio. And you see where this has kind of remained steady since the start of the financial year. And of course, this will, move up and down through time as we add new assets to the balance sheet and as assets that are on the balance sheet are exited. The important thing is for this not to jump aggressively as it would have done in 2022 when we had to take our first and only charge off. And that charge off effectively, looking historically at SCI's deployment of capital, is about 0.33% of all the capital that we have deployed. So even though it's not something that we would have wanted, but these things happen when you're running a private credit business. But we have moved on from that and getting bigger and stronger, and of course, continuously proactively managing the risk by putting on the right assets onto the balance sheet. And once they're on the balance sheet, proactively monitoring and managing those risks. And we, of course, are a private credit company, and our hallmark is speed and flexibility. And so we also try to do this in terms of working with companies through difficulties and challenges and problems. And safe to say that so far, companies that have had challenges and issues, especially the 2 years of COVID, of the COVID pandemic, we have seen where many of those structures that we utilized during that period proactively to manage, to help, not just to say, oh, I want back my money, but also to say, I want back my money under a structure whereby the company that we would have invested in is able to survive and get bigger and grow, right? And that is a subtle difference, but it's very important because that's what we exist. Our whole existence is to assist companies with flexible capital. In terms of the next two slides, I'll flip through these very quickly. Not much has really changed. Financial services sector is still the largest exposure. Construction, second largest. And of course, other. This is really about 13 different industries that is bunched up into other, which comes to 9.5% of the portfolio. So fast food is the third largest, 9.3, infrastructure 8.1, etc. So if you look at the consolidated, which includes the underlying Puerto Rico assets, that's what we're showing on the screen. If you exclude them and just look at SCI proper, then we have 13 industries, which I think is a new record, with financial services being the largest at 26.3, fast food 14.1, and infrastructure at 12.2. And if you look at the exposure by region, then Puerto Rico is just ahead of Jamaica at 32.8% versus Jamaica's 27.5%, and St. Lucia at 12.3%. And the 1-2 ratio that you're seeing here, with the capital that was raised, that capital is really focusing on Jamaican projects or Jamaican investments. You're gonna see perhaps the ratio swing towards Jamaica over upcoming quarters. Before then, Puerto Rico perhaps take back charge, right? So we expect some quote unquote movement in this allocation over the next 1 or 2 reporting quarters, just because of what we are that unfunded pipeline that I spoke about. A large part of that is really the Jamaican assets that some of which have been funded since the end of the quarter. Now to move into last 2 minutes of the slide, 2 minutes of the presentation slide. Where SCI is very committed to the region in terms of the alternative investment channel, and one of the ways that SCI is looking to enhance its footprint even more is to start to quantify and qualify all the investments that it has been doing using the impact investing lens. And given that the fund manager of SCI, which is the SYGNUS Group, became a member of the Global Impact Investing Network. And in fact, SYGNUS is the first Jamaican firm to become a member of the GIN, which is really speaking to the commitment of the overall SYGNUS to deep more engagement in the impact investing industry. So for those of you who don't know what the GIN is, Global Impact Investing Network, that's a non-profit. Is the leading non-profit organization in the world that is dedicated to effectively increasing the effectiveness and scale of impact investing. And of course, for those who don't know what impact investments are, it's basically investing with a specific intention to create a positive impact on the environment and society while generating a financial return. And of course, we are going to be going after financial returns that are market rates, because that's what we do currently. So, for example, transactions that we would have funded since the end of December 2022, when you look at the transaction, it's clearly an impact investment, but we didn't have the tools and we weren't standardized in the way that we were measuring how we actually do these investments, right? And able to say, okay, this is the impact return that we have generated in terms of the qualitative measures and figures. And of course, here's the financial return. And so we intend to communicate that to shareholders on a go-forward basis. And this is very, very important, especially given the accounting rules have also been changing, whereby we now need to report ESG metrics, right? Which is environmental, social, and governance principles. So impact investing is a very important part is becoming a very important part of the SYGNUS DNA. And in fact, this is not new to us. In Puerto Rico, as you'll see in a little bit, Puerto Rico has been doing impact investing for more than 5 years. Puerto Rico actually has 3 different impact funds. Well, I should say 4, right? Because Puerto Rico actually, has, click the next slide, Ryan, actually has what you call Lift 1 Impact Fund, Lift 2 Impact Fund, Crescent Financial Partners, another impact fund, and has launched a new $100 million impact fund, which SCI is going to be the sponsor of that fund, or is the sponsor of that impact fund through Crescent. So there are 4 dedicated impact funds in Puerto Rico that we're going to talk about a lot starting next quarter. But just giving you an introduction to that. So we have been doing impact investing primarily through the Puerto Rico business. We have also been investing, doing investment that can be classified as impact. Click back to the slide 19, Ryan. Classified as impact investing. However, we have not been quantifying these things. And so by the investment manager becoming a part of GIN, we will be able to communicate to you. For example, what you're looking at slide 19 is a kind of a general mock-up of how our report will start to look. So this does not just, a disclaimer that the report on slide 19 isn't an actual impact report. It has not been properly, the methodology to measure it and quantify it. That's not completed because our impact strategy is still being being executed, but I'm just showing you that currently, if I were to just take a snapshot of our portfolio and say, where is SCI investment in terms of its alignment, right, with the impact themes, you could see that we have capital deployed to about 10 different impact themes, and you see the amount of money that we have deployed here. This is going to be kind of very different from what our strategy is. Our strategy is going to say we are going to deliberately target certain key themes that we feel are very important to us as a Caribbean region. And we want to do a number of things. We want to deploy capital there specifically and deliberately. And we may do so by investing or co-investing or sponsoring dedicated impact investment funds, one. And as well, we will co-invest alongside dedicated impact investing vehicles, and we will do direct impact investing ourselves. And we want to do this deliberately, not by accident, right? And so the strategy will outline that deliberate action and activity. And in fact, all of the money that we are negotiating right now with our international financing partners, actually, some of those capital actually comes with a kind of what I'm going to call impact lens. So we have to deliberately deploy capital to certain impact themes as part of the modus operandi of accessing those financing. So I'm highlighting all of this to say that it's not that we are new to impact investing or anything. We have just never spoken about it in any deliberate way before. And because we didn't have any benchmark to do so, right? We have now, the manager has now become a member, the first member of the GIN from Jamaica. And therefore, when we speak going forward, we will have to speak according to international best practice and use the GIN language and help to educate our investors, all of you that are on the call, as well as our co-investors, such as pension funds that are in Jamaica, who may not be very aware of what impact investing is. Many people think that impact investing is merely donating money and you can't get any returns from it. Well, we are in the business of making money. We are a financing company, that's what we do, and we will absolutely be making money from this in the normal way that we do it. All we're doing is measuring and quantifying and qualifying our investment so that we can say with deliberate action, we are having a positive social, economic, environmental impact on society. So the next slide is just showing you, which I showed at the AGM, that Accent, has been doing this for more than 5 years, and they have actually deployed over $90 million in calendar year 2023. So they have been going gung-ho on this. They are experts at this. I said they have 4 different impact investment funds. So going to the final slide in terms of strategic update. On Accent, we are done with integration, etc. So I've taken that off the slide, and now just speaking about scaling the business, record net profit, record capital deployment for both the quarter and the 6-month period. The company is very tax efficient now. Record origination. There's a $100 million impact fund that has been launched, soft launch, so to speak. And SCI will be a sponsor of this fund, which means that obviously SCI will also be doing impact investing via its sponsorship in that fund, right? In terms of strategic growth path, everything is in progress. Private credit transactions of $1 billion. We just showed you where we have $50 million in unfunded commitments. We are showing you of a $100 million impact fund in Puerto Rico that's being launched with SCI sponsor. We are showing you that we want to raise $100 million in international financing credit facilities. We just showed you raising $50 million capital that would have raised. We are speaking about syndication as the platform gets bigger. So clearly, the path to getting to $1 billion in private credit transactions across the region, once we execute our strategy, we should be able to achieve that. Core revenues 12.5 million. That's in progress as shown by the Q2 financial results. ROE greater than 10%, similarly in progress. EPS 20% growth in progress. Dividend yield also in progress. We would have paid a record dividend in October. Would have announced it in September and paid it in October. And of course, the board hopefully will approve a dividend tomorrow when it sits for consideration. Impact investment strategy, I just spoke about that, which is basically benchmarking our alignment with impact investment theme from a global perspective. And so the SYGNUS Group became a member of the GIN and first Jamaican firm to do so. Measuring of SCI's investments, and hopefully by next quarter we'll be able to complete the strategy and be able to measure it qualitatively and quantitatively and show you. If not, we should get there before the end of the financial year. This is very, very near and dear to us, and we are taking great strides to ensure that we bring this to the fore and execute this. And then I spoke about sponsoring, investing in co-investing in impact funds and direct impact investment ourselves, because it's very, very important for our region. And finally, on the buyback, I have no update there. Would not have made any buybacks during the quarter or the 6-month period. And of course, I won't say whether or not I'll make buybacks in the in this quarter or before the end of the year. But as I said before, we have 3 years. We have up to $9 million. We can buy back at any time of night or day. That's the end of the presentation. Thank you.
Yes, thank you for that, Jason. For that detailed review of the presentation. We'll now jump into the Q&A section. So I'll just ask the questions. Surprisingly, we ended on the 3-year buyback program, Jason. That's the only question that was asked this morning, and it reads: any plans for any buybacks on the market this year?
So the way I answer that question is, I'm wondering why people keep asking that question. If you're a long-term investor, you don't need to worry about the buybacks. The buybacks will come. We have the capital to do the buyback. We'll buy back when we need to. What we are not interested in doing is to basically be buying back shares from people who want to flip, right? We're not interested in doing that. The buyback is designed to provide support and liquidity and enhance shareholder value in a strategic way. It's not for persons who want to buy the share at X price and then sell it back at Y price to flip and make a profit. We're not facilitating that. We're not interested in that. So to answer the question, I don't know at this point. I could buy back. I think we are out. We are going to be out of the blackout period as of today, right? So for all intents and purposes, we could buy back shares before the market closes today, or we could buy back shares at any time. Rest assured that the buyback is there, and we will execute as we see fit. But obviously, we can't communicate to persons ahead of time when we're going to do buyback or what the size of the buyback is, because then we would be defeating the whole purpose of the buyback. So that's the answer that I have to that question.
Yes, thank you for that, Jason. The next question is, you had mentioned that we're going to increase the fee income portion of the income statements. Are there any specific strategies or steps in doing this?
Good observation. So yes, there are specific deliberate steps which began at the start of the financial year, which is started July 1. So broadly speaking, right, we generate fee income by having the business being much larger, and by having a larger business, we are able to originate bigger ticket size in terms of transaction. And by having much larger being able to do larger transactions, we are able to actually fully underwrite a transaction. So let me walk you through what this means. So ABC company, right, wants to do an acquisition for $10, and there's gonna be, for example, a commercial bank that's gonna provide part of the funding as senior financing, right? And there are, let's say, two other parties who are also gonna participate. So the bank is gonna put, let's say, $4 out of the 10, and there's another financing partner who's gonna put $2, and the persons doing the acquisition have $2. So that's 4 plus 2 plus 2, you get $8, right? So obviously we are going to put $2 ourselves. So we have us putting $2, bank putting $4, two other investors putting $2 each, including the guys who are doing the acquisition from their equity. So what can happen in this instance is that we can get the mandate to structure and arrange the entire $10 financing. So we basically underwrite the $10 million, and meaning we give the guarantee that, hey, there will be $10 million, there will be $10 that will be available for you to do your acquisition. So we fund the entire $10, and then the bank comes in with their $4 whenever they get their approval, which can be simultaneously, or it might be a little bit after. And the other party who has their $2 to come in outside of the owner do so as well. So because we underwrite the entire transaction, meaning we provide $10 million of financing upfront, when the other parties come and do their investments, we basically earn on the entire 10 million, what I would call an upfront fee for being the party that commit to providing the $10 million to fund the acquisition. So we basically earn a fee upfront on the entire $10 million, which is that's not interest income, that's just a fee straight up. Now, if SCI only has $100 million in balance sheet capacity, we can't for example, can't underwrite, let's say, a $25 million transaction because it would be too big for our balance sheet. So, as you see with the platform at 250 million and growing, obviously we can underwrite 30 million, $40 million transaction all day, every day. Because once we go and have our syndication partners and they are committed to the transaction, then we can underwrite the entire deal, earn an upfront fee, and syndicate down. And that's a primary way in which we will generate fee income. The second way, obviously, is you have short-term bridging facilities or revolving facilities that we can again syndicate down, or we can structure them in a way that we earn fee income continuously. So yeah, I mean, those are deliberate strategies. We have a target for this. We also obviously earn fees up front on certain types of transactions. And so the pathway to consistent fee income has been established, and the wheels have begun to turn, and it's turning. And you'll perhaps see when we report Q3 that wheel unfolding exactly as I've explained. So that there's a deliberate strategy around it. And every transaction that we do nowadays, we figure out a way how to generate upfront fees from it to complement net interest income. And we need this. We are targeting 20% steady state, minimum 20%, which would mean that we expect to get to 2 million or above on an annual basis just from fee income alone to complement net interest income, which would mean that our EPS and ROE and all of those other metrics in steady state should be rising towards the targets that we have committed to, which is to get ROE in double digits and get EPS 20% growth, etc. And this, by the way, occurs in both SCI English-speaking Caribbean market. The same thing is also happening in the Puerto Rico business. So Puerto Rico business being much bigger than, well, it's gonna be much bigger than the English-speaking Caribbean business at some point, right? Just based on the size of the economy. So you can expect that the fee income will become a substantial, the dollar value figure will be in the millions of US dollars over the medium term.
Yes, thank you for that, Jason. The next question is, with Mystic Mountain having a new owner, when will SCI recover its funds from the sale? And what about Margaritaville, Cayman, and the mining company?
If I knew when, I would go out and play some kind of game that allow me to to win prizes by timing. I don't know when, right? We're working through the legal process. For Mystic Mountain, I assume that this will be very, very soon. Hopefully, and I say hopefully in quotation marks, by the time we reconvene for the next report of SCI. That's my hope. Just based on the nature of how things are unfolding. I don't think that there are that many stumbling blocks to clearing up Mystic Mountain. So that one I can say the timeline hopefully is within a month or two. As far as MV Cayman is concerned, as I said before, I'm not optimistic, right? And so the timeline is unknown, because I guess what would need to happen is that they would have to the asset would have to be sold. And as far as my information, as far as I'm aware, there are no buyers on the table at the moment. So that's an unknown. And the third one, in terms of the mining company, that as well is unknown. Of course, we are moving in terms of securing the assets, etc. So these processes have a very long gestation period. What you call workouts in the credit business, is not very sexy. It's long, it's tiring. We have to keep at it. As you can see, one would think that Mystic would have been a very straightforward transaction, right? Because you have a buyer, the money is deposited in a bank account, etc., etc. But look how long it's taking. More than 2 years has gone. So with these things, they take very long to settle. So I don't have any crystal ball in terms of timeline, but what I can say, I would expect, based on where Mystic is now, that this should be, and this is just my complete guess, this shouldn't be more, we shouldn't be coming back here and we don't have closure to the matter at the next quarterly earnings report, or before that. I would suspect, just based on where we are. For the other two, completely unknown. These things can drag on for years, man. But that's what a credit business is. And sometimes, these things will happen. The important thing is that we are absolutely pursuing all angles. We have an entire team that goes into the meetings and spends however many hours it is required, whether it's every week or whatever the time frequency, to ensure that we are protecting and can recover that capital, assuming that there's capital to be recovered.
Yes, Jason. The next question: when will the Puerto Rico fund start delivering consistent profits?
Again, good question and good observation. So right now, Puerto Rico fund is actually delivering very consistent profit. But the full reorganization and integration is just 6 months old. If we think about a normal business, takes years for business to start delivering consistently. Of course, Puerto Rico's business is 20 years old, but we have kind of reorganized how it's flowing. It has already delivered very consistent profit. If it weren't for the movement in the market multiples used to value the book value of the company, or to value the company, or to adjust the book value of the company, we would be here perhaps have $1 million extra to write home about. So what I would say to the question, based on the fact that we are using a 2-year daily price to book value multiple, and if you think about 2 years ago, with the current quarter coming up, we have a period where the multiples are very high for the first quarter out of that 2-year period, and then they normalize, and that's because you had COVID where the multiples plunged massively, and then you have coming out of COVID where the multiples obviously kind of reset, right? So you have this big sell-off and then this big recovery. So I expect normalization to happen starting in the fourth quarter, and as we move through in 2025, I would be expecting that the rate of growth in net profit of Accrescent is gonna be what I would say substantially bigger than, or is gonna start to get bigger than the impact that a change in the book value multiple can have on the income that is reported in the income statement. So right now, because the income levels, even despite the fact that we have record growth and record performance, the dollar value is still relatively low versus the change that can occur from the effect that the price to book multiple will have. But as your net profit figure gets bigger in size, the change in net profit, because I think about book value, right? Retained earnings increases book value, and obviously, if the retained earnings is growing and getting bigger and bigger, then the change in the market price to book value multiples, even though it may have an effect from movement in fluctuation in market prices, if that effect may be much lower than the rate of change in profitability. So I would expect that to start happening in or around Q4 of this year and going forward, as the business gets bigger and bigger and grows from strength to strength.
Yes. So the next question is, with SCI introducing ESG reporting and impact investing, along with raising funds from the international market, is it safe to say that SCI is now positioning itself for a potential listing on an international exchange?
Good question and good observation. Of course, if that were so, I would not be able to say so, right? but without skirting around the question, what I would say is, when we did the acquisition of Accrescent, we communicated very clearly to shareholders that SCI is about being an international investing company that dominates the Caribbean region. That's what we said, right? And we keep repeating the same thing at every AGM. We keep highlighting the fact that, okay, Puerto Rico is $100 billion US territory. We keep highlighting the fact that Puerto Rico business used to have a footprint in other Latin and Spanish-speaking territories. We keep repeating that at some point, not now, but at some point, after we become number one in Puerto Rico, knock on wood, then we will start to look to see what's the next level to scale the business. Obviously, you have US mainland and you have all of the Spanish-speaking territories that I spoke about. So naturally, if the opportunity were to arise, where SCI can list in another market, naturally we'll do that. But what I would say that for now, let's say the next 2 years or so, we're not focusing on that. For the next 2 years, we want to be absolutely the dominant player in private credit in the Caribbean, and that is all Caribbean, whether you're talking about Spanish-speaking Caribbean or English-speaking Caribbean. We want to be number one. So when you see SCI or SYGNUS credit, the first thing that comes to your mind is private credit, alternative investing, etc. And by accessing financing from international markets, which is very, very hard to do, because we have been communicating about this for like 18 months now, right? So you see how the due diligence is very, very tough. But of course, SCI is managed by SYGNUS Group, and SYGNUS Group has made some strides in terms of impact investing. So naturally, there are likely to be positive externalities on SCI from some of those relationships, obviously. So while we're not taking it off the table, in terms of if an opportunity came up and it looks good, fine. But at the moment, we are not strategically focusing on that at this moment, at this present moment. We are hunkering down, trying to, let's say get to 500 million mark in AUM across, the Puerto Rico and the English-speaking Caribbean region. So, for example, we are looking at sponsoring another private credit investment vehicle in an English-speaking Caribbean territory, which I don't really want to speak much about at the moment, early days. So those are the things that SCI is trying to do. Obviously, the path to get to the scale that we want is not a straight line, right? You're gonna have twists and curves and ups and downs. But what we want to be very, very clear about is that SCI is not about just being a small. We want to be the dominant force in private credit channel of alternative investment in the Caribbean territory. And so all of these moves that we're making in terms of international financing, standardizing and benchmarking our impact investment strategy and our impact reporting, etc., is just in keeping with international best practice. And when the day arrives, when SCI needs to perhaps look at listing in a new jurisdiction, if it makes sense to do so, we'll absolutely communicate that to the market well in advance, right? But I keep saying, that SCI is about becoming, the best company in private credit in the Caribbean region, period. And so, investors and shareholders and well-wishers and partners should really, really take those words as they are for what it is.
Yes, Jason, the next question is, SCI set to receive proceeds from the Express Catering raise. How do you plan to deploy these funds into new projects?
I see that there are some very astute analysts who are doing a lot of homework. Yes, so obviously, you know, I would have communicated prior that SCI's Jamaican pipeline was 75 million, and operative word is was, because the pipeline probably has doubled since everybody realized that SCI is $50 million. The pipeline has ballooned, right? So, if we receive another $50 million tomorrow morning, we still wouldn't have enough capital. Put it that way. We're not short of demand for private credit and flexible capital at the moment. And that's just Jamaica. Now, when you talk about the rest of the Caribbean region, it's the same, right? Our partners in certain Caribbean territories have the same need, have perhaps even bigger projects that need our support and financing, and our flexible structures. So the money that's coming back from Express, it will go back out. It's already accounted for. Put it that way. It will go back through the door. As it comes in, it's gonna go back through the door, right? It's not gonna come in and be sitting as cash and undeployed. And I said before, the answer to the question is that at the end of the quarter, we had more than 50 million in committed, undrawn facilities, and that should speak for itself. So if it's committed, it means that we are obligated to fund, right? So obviously, we would have done our homework and ramped up the origination and have everything lined up, ducks in a row, so that when the cash came in, or as the cash is coming in, it's going right back out. It's not sitting and idling. So that 8 million that will come in, it's already accounted for. Put it that way.
Yes, excellent response, Jason. The next question is, why did SCI position or increase its position rather in Puerto Rico during the quarter?
Very simple. So if you think about the private credit business and the growth, as I said before, they originated more than 40 million. They would have deployed 75 to 80% of that amount. And that was over the 6-month period. The last quarter, they did 25 million. So if you fast forward to the quarter that we are in, naturally, that business, is doing very well in terms of the growth. And I spoke about the profitability already. So we felt that given all of those, we want to support the business in its growth and expansion plan. We want the business to hit the $100 million threshold, and therefore, we felt the need to deploy an additional 3 million, which that 3 million will allow them to access enough capital to perhaps get to $20 million in new dry powder. And obviously that means that the profitability of Accrescent and the ability to underwrite sizable transactions and to continue deploying capital at the very rapid clip that they have been doing over the last 2 quarters since the reorganization and the full integration. But not only that, I think since February 28, 2022, when SCI did the initial acquisition, I think Accrescent has done well north of maybe $115, $120 million in deployment, which is an absolute record of substantial proportions relative to what they would have been doing previously to that. So all growing businesses need all growing credit businesses need capital, need dry powder. And so we, part of our strategy is actually to support the business, to help it to grow. And obviously, over the medium term, the business will start paying SCI dividends and divvying up cash back to SCI. And of course, when we are close to that period, we will communicate, which shouldn't be that long in the future, that far in the future. So all of these moves, is to scale the platform, man. We want to be able to, in Puerto Rico, to underwrite a $30 million transaction and syndicate it down and book upfront fees, etc. Right? That's what we want to do. So in order to do that, you have to inject capital into the business for it to grow. So, we continue to do that to get the business over the $100 million threshold, which would be a new record for the business, as a clean balance sheet business that doesn't have all of these other things and moving parts in it. So that's the objective: is get the business to 100 million as fast as possible, because they're not short of pipeline. Their pipeline is way north of $100 million themselves, right? So that's the reason.
Yes. And final question, Jason, before we wrap up. What's the potential spread do you plan on earning on the US 50 million raise, considering that the current yield is 14.5%?
Well, I mean, we have a target of 500 basis points. That's the spread. Obviously, financing costs are moving up, right? And that's one of the reasons why we are seeking international financing, so that when that day comes, when rates are moving down, part of our portfolio will have variable cost financing that will plummet when rates are coming down, which will give us a lot of flexibility in terms of putting our new assets on the books and capturing that spread differential. So 500 basis points is our target normally. So that's our target, and that's what we are pushing for. Obviously, where we can get more than that, we do so. As I spoke about before, if we do syndications, then obviously we earn a little bit more, right? But rates are high, and we are cognizant of the fact that we have to fund companies that have the ability to repay us. So we can't just simply say, well, rates are high and jack up the yield, right? We have to be very strategic about how we increase the rate that we are looking for on our investment. And this really comes in the way how we structure the transaction. You know what I mean? So we can't structure a facility that burdens or overburdens the company. We look at that company that's growing, is doing well. We don't want to burden the company. So we figure out different ways to structure the financing so that maybe at the front end, we're not getting 500 basis points. But by the time you get to year 2 or 3, or by the time, or in terms of, let's say we know that there's going to be what you call a liquidity event, meaning let's say the company is gonna do let's say a listing, right? Or there's another investor that we know wants to buy the company in 3-4 years time. Then we structure the transaction such that when that quote unquote liquidity event occurs, we get some additional economics. And overall, when you look at our IRR, internal rate of return, we are generating more than a 500 basis point spread. So that's how we typically try to facilitate and be flexible in the structuring of the financing. Sometimes we defer a portion of the interest that, or the coupon, or a dividend that needs to be paid to SCI to later years in the transaction when the company has generated a better level of EBITDA and performance to support paying back the cash, right? So We utilize different ways, but it's all about being very creative in how we do the structuring. And of course, in my opinion, we have the best structuring team in the region, led by Mr. Gregory Samuels and Stephen Davis, in terms of and Raul in Puerto Rico and his team, in terms of structuring private credit transactions. So anybody who's coming to SCI, whether English speaking Caribbean or Accent, SCI Puerto Rico, the James and the Puerto Rico team, and Raul and the team over there, they know that we have the capacity and the capability to structure transactions to meet the specific need that the company has, to fit into the growth plan of the company and expansion plan. And we're not trying to just make a food of the company. Really and truly want them to grow, and nothing is wrong if today we structure and finance a transaction and 3 years time the company refinance our facility with cheaper bank funding. That's what we exist to do, right? We don't exist to compete with banks. We exist to widen and increase the pie, make the pie bigger, so that banks can actually take on companies that we were the ones who, nurtured them and brought them and helped them to expand and grow. Now, they are companies that can access much cheaper financing from banks. We're happy all day, every day. We move on and find the next company that we can grow with and can grow with us, so that a bank can take them off us, and there will be obviously other relationships when that company wants to do things that banks can do. They'll come back to us because they will know the creativity that we have and the partnership structure that we use and approach to help them to grow.
Yes, thank you. Thank you for that, Jason. We've now reached the end of our earnings call. So we'd like to give Mr. Morris a special thanks for his presentations and taking our questions, and also for the persons who attended the earnings call. Special thanks to you as well. Just to remind everyone on this call that the recording will be available on the SYGNUS website, as well as on YouTube. And just for information, the the report will be or should be read in conjunction with the report published on the JC. So thank you again, everyone. Goodbye.